All right. Contract to close, successful navigation of a Florida residential real estate transaction. Today's specific topic is clear to close, the lending process for Florida realtors. In the chat, you guys know the routine. We have our handout for today. If you guys want to go ahead and get started on downloading that, so you have that resource available, that'll allow you to have your notes. And if you are somewhere where you can print that out, you can mark that up for your notes today. For those who I have not had an opportunity to meet before, got a lot of familiar faces, but a lot of new faces in the room. My name is Ray Cole Jackson. I'm a South Florida real estate attorney. Many of you know me already as being the founder of Title Experts, our title insurance and settlement services firm. A little bit about me. My background, I am originally from Miami. I attended the University of Florida for undergrad, so go Gators. I went on and got my law degree from Santa Clara University School of Law, came back home, got my LLM in real property development from the University of Miami. I am a proud Florida licensed sales professional. I actually got my real estate license before I got my law degree. Have always been interested in this real estate space. I'm also a licensed loan originator in Florida. And so with that being said, I've done it all. I've done over $1 billion in transactions in some capacity or another, representing parties in their real estate endeavors. And so by virtue of that, we've come to this place where we're bringing all of our services, all of my expertise under one umbrella, and that is the Purchase Ready Group. The Purchase Ready Group is a complete home buying solution designed to simplify and streamline every step of the homeownership journey. Hey, Della, the homeownership journey. Hey, Lisa, she made it. The homeownership journey for Florida home buyers. And so what it is a full ecosystem, full service ecosystem where we equip buyers with everything they need to achieve home ownership, right? So the main component of the service that we provide is education. Literally, we just equip buyers with education, everything they need to know about the process from lending, purchase and sale to title and closing, right? Now, as a result of that, I tell you guys all the time, every week, we partner with realtors, right? And so as we get referrals, we want to refer those individuals out. And so we would hope that those that we work with would be those that have learned with us, right? And those who are going to deliver a system that we aspire to deliver to Florida homeowners. And so through that, we have developed Purchase Ready Academy, right? And so Purchase Ready Academy is essentially coming off the grid a little bit, and then we're taking a moment on Thursdays to learn, right? To learn how do we provide to Florida buyers and sellers an ecosystem, right? So that we can consult with our clients with clarity, navigate transactions without chaos, and grow your business with confidence. We've been gathering for a couple years now. We took a small break earlier this year. Now we're back with this. But the concept that I always want to make sure that stays in the front of you guys is learn more to earn more. Learn more to earn more. Literally, learn more to earn more. And it was funny. I walked into the association today, and that was on a board. Learn more to earn more. And truly, I could tell you guys that my income earning potential always grew as I learned more. And I mentioned to some of you who were on the call before we got started that I'm here in person because there's a training on AI. And if you have not introduced AI into your business, not taking the time to carve out how to implement AI in your business, then there's going to be a couple problems, right? And so we want to make sure that you guys are implementing AI in your business. And that's going to be a conversation that we're going to have later on as we continue to work together in our community. All right. So, but with that being said, today's discussion, contract to close, successful navigation of a Florida residential real estate transaction. And then again, as I mentioned before, our specific topic is clear to close, the lending process for Florida realtors. Now, I am honored. We have a couple duly licensed real estate professionals in the room with us today, so I'm sure they can add to the discussion. But for those of us who are not yet dabbling in that space, this is going to be a great opportunity. This is going to be a great opportunity for you all to really get clarity around what's happening when my customers are speaking with the lender. What is their process? And the reason why this is important, you guys, is because number one, we're in a buyer's market. We are in a buyer's market for sure. We had been in the seller's market, as you guys know, for about definitely for 2 solid years, 2.5. We are transitioning into a buyer's market. Why are we transitioning to a buyer's market? Because there is more inventory on market, longer days on market than there are buyers. And I know that everybody wants to, oh, I represent, I'm a listing agent. I only represent sellers. Well, guess what? Sellers want buyers. Sellers want buyers, right? And if we can't bring them a buyer, that's what we're telling them. When we sit at the table with them, we're not saying, oh, I'm just going to put it on the MLS and I'm going to do a open house. Well, the purpose of doing that is to bring them a buyer, right? Sellers want buyers. And so if you know that sellers want buyers, my position is that you'll be having a different conversation with your potential sellers when you meet with them to list their properties. If you say, I have a group of pre-approved buyers that I'm going to immediately present your property to them. And in the event that this property is not a fit for them, then I'll also, of course, ensure that I market it to the other, all the other buyers in the universe, right? But if I was a seller, I would feel better if you came to me and say, I have a list of pre-approved buyers versus you saying, well, I'm going to start from zero and hope it happens, right? So with that being said, the conversation today is going to give you the opportunity to, hey, Chandra, it's going to give you the opportunity to learn the purchase loan basics, the loan application and underwriting process. We're going to talk about your relationship with the loan officer, right? They have a responsibility, you have a responsibility, but I want you guys to know enough about what they do so that you can ask the appropriate questions, right? And make sure that just in case, right? Just in case they need a little bit of nudging, that you're able to do that because you're now very clear on the lending process. What's going on in mortgage, in the mortgage market and trends. And then the bonus, right? Learn more to earn more is the implementation phase. How are you going to implement this to grow your business, right? So let's see here. We know that a home is usually the largest single investment that someone is going to make, right? Most of your customers, this is going to be the largest purchase that they will ever make, right? Aside from maybe college education, right? This is going to be the largest investment for them. And most are going to finance. If 87% of your buyers are going to utilize a mortgage loan to finance the purchase of their home, it will behoove you, right, to have working knowledge of that process. Now, when I say working knowledge of the mortgage lending process, again, it's not for you to know the intricacies, but it's enough for you to answer 30,000 foot level questions, make your buyers comfortable with the process because a lot of them are uncomfortable, right? They say a confused mind takes no action, makes no decisions, right? So oftentimes when people are saying no, it's not that they're really saying no, they just don't know enough to make a decision. But with you, because you're generally most oftentimes the first point of contact, we're going to make sure that you know enough to educate your prospective buyers that they should take the next step, right? We know that real estate is one of the most important wealth builders, right? And so we don't want our potential buyers to miss out on that opportunity, right? So I have our hypothetical client today is Kayla. We're going to help Kayla purchase her first home. Kayla is 29 years old. She's a pharmacist. We're going to make this one easy. She's a pharmacist, right? Annual salary of $105,000, 720 credit score, 720 credit score, right? We're going to make this one easy. So at a 30,000 foot level, here's what you should know about the lending process. First step, submit an application. The borrower is simply going to submit an application to the lender with their supporting documents. The lender is going to receive that application, receive their supporting documents, and then they're going to either pre-qualify or pre-approve them, depending upon their service level. Pre-qualification is when they make sure that they have reviewed the documentation and they say that you qualify, right? Pre-approval means that I've sent this information and application to the actual lender, and the lender has reviewed it and said that you qualify. Pre-qualification is generally done by the loan officer, Pre-approval is done by the lender, right? So that's one nugget for you already, right? The next step is once we know that the buyer is pre-qualified or pre-approved, we're selecting the product. What loan product are we going to utilize for this borrower, right? Is it going to be an FHA loan we're qualifying them for? Is it going to be a conventional loan that we're qualifying them for? USDA, VA, is it a DSCR loan? Do you work with investors, right? We're picking a product. We're picking a product. Now, once we know what they qualify for, what product they're likely going to utilize, then you're going to go under contract. At that point, you're going to go shopping. You're going to go find a property and go under contract, right? And then from there, the application is submitted to the lender again. And then the lender works through the requirements or what we call conditions. And then they issue a clear to close. Now, that's a very, very high level review, but this is their process. And for some of you, you may not have known this. And so at least know this, that this is at a very high level what the process looks like. Application, pre-approval, selecting the product that they're approved for. We go shopping, we go under contract. That contract then goes to the lender for a full final review, right? Now, understanding that, let's talk about each of these milestones. Now that you know that those are the major milestones, let's talk about each of these milestones. Loan application and pre-approval. So we know that buyers can, of course, apply for the mortgage loan after they've chosen a property to purchase. We know that we can do that, right? We went over our contract numerous times, and we know that there's a provision in there that gives a deadline for the borrower to make an application. However, you're not working with the buyer who has not already been pre-approved or pre-qualified, right? Never. No, you're not doing that, right? So, and the way that they will become pre-approved or pre-qualified is for them to make that application. So anytime you are contacted by a buyer, you're asking them, have you already made an application to a lender and gotten a pre-approval or pre-qualification? All right. First question off the bat. Now, being pre-approved for a mortgage, of course, gives the buyers an edge in that they can make their offer to a seller saying that they've already been pre-approved or pre-qualified, right? If you're right now we're in a buyer's market, but that's just a fundamental, right? Whether we're in a buyer's market, definitely in a seller's market, submitting a pre-approval or pre-qualification letter is a fundamental, right? You should require that your buyers obtain a pre-approval or pre-qualification letter before going out to show homes and making an offer. You have to require this, guys. Otherwise, you don't know what you should show them, right? You don't know what they can afford. Now, assuming they made their application, purchase loan basics. I want to make sure you guys know this quick terminology. You should know this. This comes up in closing a lot, or it comes up in closing when we're having a conversation with realtors and their buyers who, for example, are married, but both parties are not on the loan, right? So I want to give you guys some quick terminology. Take this with you. The note. At closing, they're going to sign a note. The note is proof of an agreement to repay a debt, right? So Kayla makes her way to the closing table. Kayla has found a property that she's looking to purchase for $450,000, right? She gets a loan for $435,000. The note is going to be is her agreement to repay the $435,000. The mortgage is going to be what she executes at closing, which is going to make that real estate collateral for the debt. The mortgage is going to be recorded against the property at closing so that in the event that Kayla does not pay, it will give the lender the right to foreclose. All right? So I'm going to say that again. The note is the agreement to repay the debt. The note is not recorded. The mortgage is the agreement to create a lien on her real estate for repayment of that debt. such that in the event that she does not make a payment, the lender can foreclose and take the property. So that's the difference between those two documents. Now, going back to my quick example, if you have a husband and wife, for example, husband is purchasing the property, husband is on the debt. The lender used the husband's, the husband made the application, the lender used the husband's income, the husband's credit, all of the husband's information to qualify for the loan. So the husband is on the debt, did not use any of the wife's information. So the husband is going to be the only person at closing to sign the note. However, the husband and wife are going to sign the mortgage because the mortgage is going to create a lien on that property. That property has a homestead right in Florida. In Florida, we require that anyone who has a homestead interest in that real estate signs the mortgage, because a homestead interest, as we know, it protects that property. But that's why you sign the mortgage, because we know that in Florida, you can't take my house unless to repay a debt, you can't just take my house. We have what we call homestead protection, unless I agree that you can take my house if I don't make a payment. And that's what the mortgage does. The mortgage is an outright, I agree that you can take my house if I don't repay you. And so a spouse who also has a homestead interest in that property must place a lien on their homestead interest, which will also be foreclosed on in the event the note is not repaid. Right? All right. So, who are the loan professionals? This is important to know. Know that there's a difference between a loan officer and a mortgage broker. Oftentimes, many times we just say the lender, and you probably will continue to say the lender after this call, but you'll know in your mind that there's a difference between a lender, a loan officer, and a mortgage broker, right? So a loan officer generally works for a bank, a credit union, or another mortgage lender directly. A loan officer will offer only the programs that are available from that institution, right? So for example, Lisa's on the call. Lisa is a duly licensed loan officer and realtor. She is a loan officer with the Federal Credit Union. When Lisa works with her clients, she can only offer them the loan products that are available through the credit union that she's a loan officer with. That's it, right? Versus a direct lender is an institution or private entity that actually provides the funds, right? Actually provides the funds. So you make an application to Purchase Ready Bank. If we're a direct lender, then the money is going to come from Purchase Ready Bank. We are a direct lender, right? Another example of that is, of course, your Bank of America, your Chase, your Wells Fargo. If you make an application, you go into the branch, you make an application to Bank of America, Chase, Wells Fargo, that money comes from them, right? Now, versus a mortgage broker. A mortgage broker is an intermediary who brings mortgage borrowers and mortgage lenders together. That mortgage broker does not work for any specific lender. They don't work for a specific credit union. They don't work for a specific bank. They are an intermediary. They're going to shop your application. They're going to shop various lenders to find out which lender has the best product for you, right? So the example that I like to use, so I'm sure you guys are going to understand this. Let's say, for example, the loan officer is Cheesecake Factory. If you guys have ever been to Cheesecake Factory, they have a very expansive menu. So you can order anything off that 10, 12-page menu. The mortgage broker is DoorDash, right? DoorDash just has, you just swipe, 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 right? The mortgage broker just can go outside of Cheesecake Factory. They can go to Panera, Brews Room, whatever, any of you name it, BJ's, Red Lobster, you name it, right? So that's how a mortgage broker works. So when your customer comes to you, you should know, you need to know whether they're working with a loan officer that works with a one lender or they're working with a mortgage broker. I'm going to use one more example for you because it's going to bring it close to home for you guys. New construction development versus retail. If I go and I work with a realtor that works just for D.R. Horton, she's going to show me what D.R. Horton has. If I go with Steve, and I don't know if Steve works for any builder, Steve is going to take me to see many properties. It may be D.R. Horton, it may be Lennar, it may be Pulte, it may be anyone, Mattamy, or maybe some resales, right? So look at it that way. Now, what does that mean for you and your business? It means that in the event that you run into a hiccup potentially on a transaction, generally a mortgage broker is just going to have more options. Doesn't mean that they're the best, but you just have to know it's just a fact of life. They have more options. All right. They can reach outside of only what's in their institution. All right. So, quick synopsis of that so that you guys know the difference between a loan officer and a mortgage broker. Now, how is a lending professional paid? Similar to how you're paid as a realtor, they're paid a commission at closing. That commission is either paid by the lender or by the borrower. Sounds familiar? Your commission is sometimes paid by the seller or by the buyer. It depends upon how that transaction is negotiated, right? So that's how they're paid. Now, loan types. I want you guys to look at this section as products. Remember, I told you guys that a loan officer has a set of products that they can offer the borrower or buyer. A mortgage broker has a very large repertoire of products, because not only do they have different products, not only do they have different lenders, every lender has a different product. Again, DoorDash versus a menu. Menu is Cheesecake Factory. Here are the items that Cheesecake Factory has on their menu. Versus DoorDash, DoorDash is saying, here's all the restaurants and here's all the menus for those restaurants. So, what are some of the options? The type of loan, mortgage loan that a buyer obtains is going to determine their interest rate, their loan terms, the difference between an MLO. Okay, we can do that really quickly. Actually, is that in the handout? Minnie, check the handout really quickly. Just want to make sure. I'm gonna pop back really quickly. Do a quick screenshot for me. I'm gonna move a little quick today because we got a lot of content today. I usually try and keep you guys 45 minutes. We won't get all of these 50 minutes. And probably didn't some. All right, so there's a quick screenshot for you. All right, no problem. All right, so loan types. FHA, Federal Housing Administration. Know that FHA loans and conventional loans are two of the most common mortgage loan types that your buyers are going to purchase homes with, right? So FHA loans. Quick bit of background information for you guys. FHA stands for Federal Housing Administration. These are loans that are backed by the Federal Housing Administration and offered by FHA-approved lenders, right? And so the FHA is not the lender themselves, but they insure the loans that are offered by their FHA-approved lenders. It's insurance for the lenders who are going to make loans to these borrowers. The underlying idea of this insurance framework is that it would allow more people to qualify for mortgages and to buy homes if lenders were provided with insurance, right? And so what this is saying is it relaxed the lending requirements, because I know that the FHA is going to repay me in the event that this borrower defaults, right? So it protects them from their losses. That's what an FHA loan does. So because the FHA lenders have this insurance, it's ideal for first-time home buyers. It's ideal for them, right? FHA lenders will allow for lower down payments. We know that that's about 3.5%. It was 3% at one point. More lenient credit requirements, even more lenient debt to income ratios. Because again, if you don't repay me, the federal government is going to, right? They're going to make me whole. And that's the point. That's the entire purpose of it. Now, even though FHA loans are ideal for first-time home buyers, ideal for those who may not have as much assets, cash available for a down payment, may have a higher DTI, but guess what? It may be a lower credit score. They don't have a maximum income limit or a maximum credit score, right? You can make $500,000 and have an 800 credit score. But if you want to go FHA for whatever reason, you can do that. All right. Now, if you're in that situation, you're probably it's probably a better product for you, right? Because there is some cost involved with FHA loans, right? But I want you guys to make sure you understand that there's no limit, right? You can't say, "Oh, my client is a doctor. They wouldn't want an FHA loan." You never know. Maybe they want to keep their cash. Who knows, right? An FHA applicant can qualify with a credit score as low as 500. However, most lenders require at least a 580. At least a 580. And higher scores are always preferable. Understand that interest rates, guys, are based on risk. The lower your credit score, the greater your risk is to a lender. And so, of course, the higher your interest rate is going to be. FHA loans require 3.5% down payment. If your credit score is 580 or higher, if that credit score is 579 down to 500, then the down payment has to be 10%. Again, risk, right? So if you're looking at an FHA buyer, you want to make sure that their credit score is at least a 580. Some lenders were even at 620, but most are relaxing that now. Again, we're in the buyer's market, right? So marketing point, 3.5% down, less than perfect credit. Because again, many people think they have to put 20% down, and that's just not the case. Exact rules vary by each lender. Remember, one lender may take 580 and be just fine with it. Another lender may say, we only go as low as 620. That's why you work with a professional that can shop them around potentially. All right. All right. There are limits on how much of an FHA borrower, how much of a buyer can borrow. FHA loan limits are set by region. I'm gonna see if I can drop this. Where's my chat? Let's see if I kept this. This amount changes every year. In the chat, I just dropped for you guys the FHA loan limits by each county in Florida, so that you can see what that is. So what that means for you is, you know, the max purchase price that your borrower has and still be able to qualify for an FHA loan, right? Still be able to qualify to be able to put just 3.5% down, right? Once they get past that, then they can't utilize that product, right? Now, of course, we want to always tie everything in. We're talking about FHA loan. We got to remember our contract. If your buyer if your buyer has been pre-approved or pre-qualified and they intend to use the FHA loan, make sure you use your rider. All right, make sure you use the FHA rider. VA loans, Veterans Administration. They are also government loans. They are administered by the Department of Veterans Affairs, and they are designed for retired and active duty military members and their spouses. This is another loan program that is highly beneficial to VA, to those that qualify. If you work in this market, if you have the ability to focus in this market, I encourage you to. VA loans have no down payment. No down payment. What is the greatest hurdle for most buyers? Down payment. A VA loan, if the borrower qualifies, no down payment. Very competitive interest rates. And even though they are not making a down payment, they have, Katya is asking the question exactly. They don't have to make mortgage insurance. On an FHA loan, they do. Yep. So Katya asked a question in the chat. She said, what about insurance on FHA loans? Absolutely. So you have to make, with an FHA loan, because your down payment is less than 20%, you are going to make you're going to pay mortgage insurance. And that's the point I was exactly about to make with the VA loans. Even though they make no down payment, they don't have to pay mortgage insurance, right? So we know that generally any loan product where the buyer is making less than a 20% down payment, there's going to be mortgage insurance until they hit that 20%. With the FHA loan, that mortgage insurance is there for the life of the loan. That mortgage insurance payment is actually also how FHA is able to create the pool of monies that makes their FHA approved lenders whole in the event of a default, right? So You make small payments over time on the ability to make just that 3.5% payment. All right. But I do believe that if you ask me, I think it's well worth it. So Gina's question is, how flexible is the credit score? The VA has no minimum credit score. Here again, the lender, depending upon the lender that you're working with, they may have a minimum. Good question, Gina. Look at the contract. Reminder, there is a rider for the VA loan. So if your buyer is qualified for a VA loan, make sure you use your rider. All right. All right. USDA loans. USDA loans, United States Department of Agriculture. These loans are intended for purchase of residential homes in rural areas. Now, when I say rural, it's not like in the woods per se, as you see here on the screen. There are areas in Port St. Lucie, for example, that if you just push out just a little bit, that area qualifies for USDA loans with some income limitations considered. This one does have a income limit. They generally also require no down payment. They also have flexible credit scores. But this is another product that is available. Again, it's not as common as VA, of course, FHA, even conventional, but it is a product that you should know about, right? And again, if you are, I did this training one time, and there was a realtor. She said that was her farm area was a USDA area, and the majority of her buyers use USDA loans. And so, I did not grab the map. There's a track that shows you what areas qualify for USDA. I didn't grab that. I'll make sure to put it in the school community. Minnie, make a note to remind me to drop that link in the school community for everybody. All right. All right. Conventional loans. So conventional loans are loans that are not backed by a government agency, right? So we talked about FHA, VA, USDA. They are backed by a government agency. They are going to make the lender, the direct lender, whole in the event of that borrower's default. And so because that direct lender has insurance, that allows them to relax their lending requirements. Versus conventional loans, they are not insured by any government agency, right? And so, of course, that creates greater risk for the lender. Because that creates greater risk for the lender, of course, their lending requirements are going to be a little bit higher. And what those requirements are, again, it depends on what product the buyer is looking at. Now, conventional loans are even broken down even further into two categories, right? So we've gone from, we call them govies, government loans, we call them govies in the lending space, to conventionals. Now we're going to break down conventionals. Conventionals are broken down into two categories as well, conforming and non-conforming. Conforming and non-conforming. A conforming loan is a mortgage loan that meets the dollar limits of the Federal Housing Finance Agency and the funding criteria of Freddie Mac and Fannie Mae. What are you talking about, Ray Cole? A conforming loan means that these loans fit the requirements for Fannie Mae and Freddie Mac to purchase them. They're willing to purchase them on the secondary market. Fannie Mae and Freddie Mac are not government entities specifically. They're what we call government-sponsored entities, or GSEs. Both Fannie Mae and Freddie Mac were created similar to FHA to provide liquidity and stability and affordability to the mortgage market. FHA's feature is insurance. Freddie Mac and Fannie Mae's feature is repurchase on the secondary market. So how does that help a lender? So whereas a lender might not have insurance on a loan, they are made whole because they can sell their loans to Freddie Mac and Fannie Mae to get their money back. And then they just do more loans. Lenders make money by lending, right? We're in the buyer's market. They want to do loans. They're going to give all type of concessions and features and credits and you name it, because we don't make money unless people borrow, right? And so Freddie and Fannie are going to purchase these mortgages on the secondary market, which fuels these lenders to go out and make more loans, right? So what is a conforming loan? A conforming loan cannot exceed a certain dollar amount. For most of Florida right now today, The conforming loan limit is $806,000, $806,500. That is a lot of money, guys. A few years ago, it was 7. We've gone up 50 something thousand dollars. That's a lot of money. That's good. That's a good place to be, right? The limit is higher in some more expensive areas. For example, in Monroe County, the limit is $967,150. That's almost $1 million for a conforming loan. Meaning, this is not a risk yet, per se, for the lender. So again, you can get better terms. You're not looking at as much down. You're not looking at as much of a higher interest rate. You're not looking at as much liquidity of the borrower, right? Now, those that are not conforming or non-conforming, the common term for those are what? Jumbo mortgages, jumbo loans. Those of you that are in the luxury market, right? Anything above that 806.5 loan amount is jumbo. Is jumbo. Now I want to make this point. Remember, this is the loan amount. This is not the purchase price. So let's say, for example, you have a buyer, they want to purchase a $2 million property and they have $2 million. But then they're like, you know what? I want to hold on to my cash. They can utilize a conventional conforming loan. They can just take a loan out for $800,000, right? Versus taking a loan out for 2 million or 1.95. You get what I'm saying? So this is all content. This is content. This is information for you, content for you to educate a potential buyer or seller, right? All right. So jumbo loans, they're non-conforming. They're non-conforming. They are the greatest risk because, as we mentioned, Freddie and Fannie will not repurchase them. The lender will keep these loans on their books. So for that reason, as we talked about before, more risk, right? More risk. So they want a better buyer profile. Interest rates are probably gonna be higher. Down payment is higher, right? Because they don't have that backup. Now, non-QM loans, that's your DSCR loans. DSCR stands for debt service coverage ratio. If you guys work with investors, those that are purchasing a short-term rentals such as Airbnbs, right? Vacation rentals, apartments. DSCR loans are not for primary residences. This is not for a home buyer. This is not for someone that's going, but this is for a past client who has their primary residence, and now it's time for them to purchase investment real estate. For those of you who want to operate in that space, you're going to be talking about in your marketing content non-QM loans. You're going to talk about that product. The process doesn't change. We're talking about this particular product, right? At the juncture where we're selecting the product for the buyer. Bank statement loans, 1099 loans, anything that non-W-2, you're looking at what we call non-QM loans. All right. So those are loan products. Now, we talked about products at a high level. Interest rates. Interest rates, as I mentioned before, they're based on risk, right? If you're a lower risk, you're going to get a better interest rate. Now, but still, we know that interest rates start, of course, based upon what's going on in the market, and then they build from there. We're not going to see 2% interest rates again. Probably not in our lifetime. I think I can say that pretty confidently, right? That was a market stimulator. That was a complete outlier. That was a reaction to, we don't want people to not buy. The real estate market drives so much in our economy that when it stops, a lot of things stops, right? A lot of things stop. And so that was a motivation for the real estate market to continue. Now, what you guys need to know about interest rates for the purposes of today is just know the difference between fixed rate and adjustable rate. Fixed rate mortgage has a fixed interest rate for the entire term of the loan. This means that the interest rate is never going to change. Now, that doesn't mean that their payment isn't going to change, because most borrowers, their payment is what? Principal, interest, taxes, and insurance. Taxes change, insurance change. The principal payment and the interest payment won't change, but the taxes and insurance do. right? And so for that reason, their payment can fluctuate, but at least they know that that interest rate is not going to fluctuate. It's going to be the same, right? Once that interest rate is locked, it is not going to change for market conditions. Hence, we have some people now that are what we call landlocked. They have a 2%, 3% interest rate, and they're like, I'm not leaving it, right? I'm not seeing that again. I'm not selling this property because I don't want to lose that interest rate. Now, some people, if they're educated properly, they may find out that even with them currently having a 3% interest rate, making a change, making a sale, refinancing is a better financial decision for them. But that's a different conversation. All right. Adjustable rate means that that interest rate will adjust over time. It will adjust over time. Right. And so when it adjusts and how much it adjusts is based upon what the buyer agrees to when they make that loan application and they select that product, right? An adjustable rate mortgage is a product type. So the application, give you guys a little bit of insight into this. Generally, the application does not change. That application does not change. The underwriting process follows what I teach is an acronym of IPAC: income, property, assets, credit. Income, property, assets, credit. To get a full approval, the lender's underwriter is looking at the borrower's income. They're analyzing the property. Does the property work for the loan product, right? Does the borrower have sufficient assets, meaning funds available for their down payment? And if there's any reserves requirement, reserves means they may have selected a loan product that requires them to have a certain amount of cash in reserve after they close. For example, I represented a young lady. She purchased a fourplex, and so she had to have a couple $1,000 in reserve after closing, and so her bank statement had to show that, right? And then of course credit, IPAC, income, property, assets, credit. If you guys don't do anything else, if you don't talk about anything else in your marketing when you're trying to educate buyers on financing a purchase, this is a great one because you want to give them so that they can easily digest. So you say IPAC. Let's pull the shape, pull the screen back. Here's the mystery behind. If you ever wondering what exactly is the lender looking at when they're saying whether or not I'm going to get a loan approval, they're looking. It's IPAC, guys. Do you have sufficient income to pay the mortgage that you've asked for? Does the property qualify? Meaning, we're in South Florida. If they're looking at purchasing a condominium, if that condominium is not in a, let's say, FHA approved, or it's not an approved community, or it's not in any properties in an insufficient condition, then it's not going to check that box, right? Assets, do we show sufficient funds on hand or cash to close? And then do we have sufficient credit? That is literally it. Those are the 4 boxes that they're checking, right? All right. So income, property, assets, credit. Do they make enough? Is the property adequate? Do they have enough cash on hand? Does their credit qualify? We check all 4 boxes. They're getting it clear to close. They're getting it clear to close. That's it. All right. Loan application documents. This is another piece of information, staple in your marketing. Staple in your marketing. 30 days pay stubs that show their income, as well as their year-to-date income. 2 years of federal tax returns, depending upon the lender. 60 days, or what you would say 2 months of bank statements. If they want additional income to be used in the calculation of income, then they need to show that, such as alimony or child support. Of course, their driver's license, social security number, and then the lender will need to verify their employment. They need to show 2 years of employment. Now, 2 years of employment, let's say someone's just graduating. College can qualify for those 2 years. They have a good job now, right? They've been working for 6 months, but they were in school. Let's say, for example, they are a teacher. They've been teaching for 6 months. They just graduated from college. They were getting their degree in education. That can substantiate for the 2 years, right? All right. Now, underwriting is the process through which an individual, like an individual lender, could be a private lender or institution, they take on a financial risk for a fee. So they're taking on the risk of lending you $100,000, $500,000, $600,000, but for that there's a fee, right? And that's their interest rate. That's what they're charging you for borrowing their money, right? Now the credit report. Here's another piece of information I want you guys to make sure you capture, use it in your marketing. Credit report. We know that the lenders are going to pull the credit scores from the three major bureaus. The lender is going to use their middle score. They're going to use the borrower's middle score. So let's say we're using Kayla. Kayla's credit scores were 700, 720, and 740. Her middle score is 720. The lender is going to use 720 in her loan application underwriting review. Let's say, for example, Kayla is married. Kayla's credit scores are still 700, 720, 740. Her husband's credit scores are 710, 730, 750. They're using 720 still because they're using the lower middle score of all borrowers. The lower middle score of all borrowers, right? The loan approval. Let's look at the contract. Again, we want to make sure that this is not just about understanding the underwriting process. We as realtors have to make sure that that underwriting process is in sync with the contract. The last few sessions, we've been talking about timelines. So I'm going to use this as an opportunity to remind you guys about the timeline that's in the contract, and that is your loan approval, deadline, right? So paragraph 8, loan approval deadline. We need to know for sure. We need to make sure that the lender, loan officer that you're working with, that they get your clear to close, or they get your loan approval by your loan approval deadline, right? Remember, we have a built-in deadline for the buyer to notify the seller whether or not they've been approved, and notify them in writing whether or not they've been approved, whether or not they have not been approved, and so they're canceling the contract, or I don't know, can we extend my deadline? Or I don't have an approval yet, but my lender's Superman, so I'm just going to go ahead and continue. You have a deadline. You have to follow this deadline. So this is where the lender's responsibility and what they're doing with their underwriting ties into your work. Monitor your financing contingency deadline. We don't just throw the contract into title, throw it into the lender and say, all right, see you at the closing table, let me know. No. Make sure that they know that there's a deadline for this review to take place, right? And hey, Mr. or Mrs. Loan Officer, I need to hear back from you by this deadline. Otherwise, our borrower's deposit could be at risk in the event you don't get this done. Okay, so ensure that the lender has calendared the loan approval deadline. Make sure that you have calendared the loan approval deadline. Make sure your transaction coordinator or anyone that supports you and managing your contract timelines has this date identified. Now, the last point I want to make with regards to this juncture, this is called, of course, the conditional loan approval period. You want to be involved in this conversation to the extent that you want to make sure that the conditional approval does not look like, doesn't look like what you would get when you first make an application. So for example, you get a conditional loan approval back and they're asking for tax returns from 2020. You're like, what? Why are we asking for tax returns from 2020 at this juncture? Like, income should have already been worked out, right? When your borrowers get a pre-approval or pre-qualification, let's go back to the acronym: income, property, assets, credit. Income, assets, and credit, the lender should have already been able to check that off. You should have already been able to verify my income. I gave you my pay stubs. I gave you, you verified my employment, right? Assets, you have my bank statements. Credit, you ran my credit. Why are we still having this conversation about income at this juncture? At that level, at least. At this point, the only thing we should be doing when you go under contract, if that borrower has been pre-approved sufficiently, it's the property. The only thing we should be looking for is making sure that title tells us that title is clear and we get an appraisal. So watch that, guys. Just watch that. Okay. Vicious question says, how does this work if it's new construction? New construction is going to have their own contract with their own timelines, and you'll have to abide by those timelines. All right. So just a reminder, if the buyer does not have their loan approval by your loan approval deadline, you want to make sure that you either extend the loan approval deadline and the closing date, or if you think that they're not going to get it from talking to the lender, then you need to cancel the contract. Because if you do not, then you are proceeding with putting your buyer's escrow deposit at risk. Lastly, if you have a buyer that says they're in a situation where they don't have a loan approval and you cannot get an extension, they really want the property, lender's telling you they're going to be able to get it done, I suggest that you get in writing that the buyer is aware that should the lender not be able to get them approved by closing, that they could potentially lose their escrow deposit. Okay. All right. TRID disclosure. I see your question, Kevin. Give me 1 second. TRID, we know that it stands for the TILA-RESPA Integrated Disclosure Rule. The only thing you need to know about this is as we get up on the closing date, you know that TRID requires that the buyer, if it's a finance transaction, that they must have the opportunity to what we call have a 3-day disclosure period. So they get 3 days to in between receiving their closing disclosure and closing. They must get that 3 days. They must get that 3 days. That is even in our contract, right? So what ends up happening is, let's say, for example, the lender is they finally get the clear to close a day before closing. And so they get the clear to close and they finally get the CD out a day before closing. Well, they have this 3-day disclosure rule. They have to allow the buyer to cool off and have this CD for 3 days. And so the contract has a built-in extension of the closing date to give the lender and the borrower the opportunity to exhaust their 3-day disclosure period. Right? All right. So we're coming up on our clear to close. Now, just to reiterate regarding your relationship with the loan officer, how to identify a lending partner. We talked about the difference between a loan officer and a mortgage broker, right? If you don't already have a relationship, I suggest to you that you 100% have a relationship with a loan officer or mortgage broker, whomever you decide to work with, now that you understand the difference between the two, right? Because you should be able to, as we do at Purchase Ready, you should be able to present to your buyers what you want to provide is and your sellers an ecosystem, right? You want to provide a simplified process to either buy or sell real estate, right? And to the extent possible, you want to make sure that to your consumers, it's all under one umbrella, or as I describe it, all under one roof, right? So you want to identify your lending partner. Now, very important questions you need to ask before you go under contract. Has the buyer received a pre-qualification letter, a pre-approval, or DU approval? Remember, I told you guys the difference between the two. You want to know if they've received just a pre-qualification letter, which has merit, but understand that the pre-qualification letter is their application has been reviewed by the loan officer, versus the pre-approval, it's been reviewed by the lender, the actual underwriter that is ultimately going to make the final decision. See the difference, right? So again, pre-qualification has weight, pre-approval has a bit more weight. Okay. Ask the lender, can the buyer afford this property? Now, what does that mean? That means they have a limit, debt to income ratio. They have a max payment that they can make, principal, interest, taxes, and insurance, right? And so you have a loan amount, you have a max payment. Well, we go to look at this property. This property is also in an association. And as monthly association payment, the monthly association payment is $700 a month. Lender's gonna say, "Oop, nope, that is out of range. They can't afford that." Or maybe the taxes or the insurance is too high, right? So you want to know that. How soon can the lender close? Ask them. We're in the buyer's market, yes. It's more relevant when you're in the seller's market, but how soon can you close? Well, maybe you're in the buyer's market and your buyer needs to move quickly. How soon can you close? Going back to what we talked about, how well has this buyer been underwritten? Do we already literally have income, assets, and credit checked off, and all you need is me to find a property? And if title can close in 2 weeks, can you close in 2 weeks? Find out, right? Will the property be approved by the lender? Is it in an association and it's not FHA approved, right? Are there any limitations to consider based on the intended loan type, right? So let's say you intend to request seller concessions, but that loan product has a maximum seller concession amount. Is there anything I need to know before we write up this contract? And then can the buyer pay more than appraised value? We're in the buyer's market. You should not be running into that in South Florida at all, right? But when we're in the seller's market, you really wanted to know that. So those are some of the types of questions you should ask. Now, just to reiterate, once you go under contract, even prior to going under contract, right? When you are referring a buyer to your lender for them to get pre-approved, stay in constant communication with them. Communication once you go under contract, of course, is more important than pre-contract, but you want to make sure that you have a line of communication open, especially again, once you're under contract and you're facing these deadlines. Did they provide you with a new bank statement? Did the HR department confirm that they're still employed there, right? Did they get you that new or current identification? Did they get you the letter of explanation that you needed? It happens. Staying current with mortgage and market trends and interest rate changes. Again, I would, for you guys, you don't have to be so technical. Using the standard information, as far as current market information, we know that Hometown Heroes is coming up. Some local markets, some local municipalities, they have down payment assistance programs. If you know that you work with the community that can utilize down payment assistance, what about programs through lenders? So, for example, our office, we're offering a $2,500 credit to buyers at closing. Coming up, there's going to be a free appraisal for veterans. So those are some of the types of things that you can talk about in order to market the money, right? And get buyers to call you and reach out, right? So the bonus for today, as we wrap up, and we did very good, usually take a little bit longer than this, using your mortgage knowledge to grow your business. Guys, I cannot tell you how valuable lending information is. Market the money. Market the money. What do big stores do? Oh, 50% off. They're speaking to their pockets, right? 10% off. Market the money. Show your prospects how they can afford to make a real estate investment, right? You don't need 20% down. You don't need a perfect credit score. You don't need a 720, right? There are sellers are making concessions. There are credits available. Let's strategize on how you can purchase a home in 2025. Same thing with sellers. Here are some strategies. Here are some concessions we can make to make your house more affordable, right? When you think you've run out of things to say, market the money. Market the money, right? Take what you learn and inform the consumers. You want to let them know, this is my line, you can have it. I won't even sell it to you. A loan for every home. That's a free one. A loan for every home. You literally have a loan for every home. You do. You might not know specifically what it is, but you call your lending partner, call me. I'll tell you. A loan for every home, right? Post the information, promote it, share it, grow your business. We are in a buyer's market. We're in a buyer's market, and people are ready to buy. All right. So I'm going to answer these questions really quickly. From Kevin, it says, from getting pre-approved with the interest rate, when is the rate locked and how long does it last? That's a very good question, Kevin. So Kevin's question is about a rate lock. So in case anyone's unaware what a rate lock is, so it allows the buyer to lock in a rate. We know that interest rates change. They go down, they go up, they go down, they go up. And so the question is, when is the rate locked? It is locked when the buyer indicates that they want to lock the rate. And how long does it last? So that's a good question. That's also a term in the mortgage, in their interest rate. And so most buyers are gonna lock for about 30 to 45 days, but you have the ability to lock for longer than that. You're gonna pay for that. And likewise, if you don't need that long, if you only need 2 weeks to close, then you can lock it for just 2 weeks, and then you'll get a credit for that. Does that make sense? But that's a very good question. But as a general matter, let's start here. When the buyer is at a rate that makes sense and that allows them to make a payment, they need to lock it. That you should not gamble on interest rates. Okay. I'm glad, Lynn. Can I have your contact info, please? Sure. Beta, the handout, Beta, do you have the handout? My contact information should be in there. Minnie also, let's see here. I'm going to slide through and show you my email address. But really quickly, guys, if you do not have, if you're not already, you don't already have access to our community where this recording, this handout, and prior recordings or handouts are being housed, then you need to join that school community. The QR code is there. Also, it'll be in the handout. Many of you can drop the link to the, you're welcome, Gina. If you can drop the link to the school community in the chat, that'll be great. Invite your colleagues. If you guys found value in this and you think that others will find value in this, be sure to invite your colleagues. We are here every week. Purchase Ready webinars, purchasereadywebinars.com, every Thursday at 12 o'clock. And then if you're not receiving emails or updates, shoot us an email. We know that over the prior few weeks, there was some, sometimes, I'm just gonna tell you, sometimes the emails go to spam. So guys, check your spam and make sure you mark the email as safe, because we do send out emails. Sometimes they're not being received. If you're saying like, I haven't heard from Ray Cole in days, like something's wrong, shoot us an email, okay? And then lastly, follow us on social media. We would love to chat and engage with you and like your posts and root you on and reshare your stuff. So follow us on Instagram and Facebook. All right. All right, guys, we did it. We got through a ton of information in just 5 minutes over. All right. So there was a lot to digest. Make sure that you guys grab access to the replays and the handouts. If you have any questions, good to see you, Alette. If you guys have it, go ahead, Dominica. You have a question? You can come off mute if you like. You asked it earlier?
Oh, I'm sorry. I'm using my husband's computer.
No,
was the seller concessions? There was something about, I missed that when you're doing the, when you're talking
you
to the
didn't say
lender
that.
and
Can you
seller
explain seller
concessions.
concessions and loans and what to add? Okay, perfect. Okay, so seller concessions. Seller concessions is a fancy word for money, right? So a seller concession can say, oh, we're asking for 3%. Now, how you use that concession is up to you. The concession can be they would use that 3% cash towards their closing costs. They could use it towards interest rate buy down. Again, that's a whole nother conversation. I should do a whole class on seller concession. Minnie, write that down. That's a whole good job, Dominica.
Yes, yes, please.
How to use seller concessions. That is, we'll do that next month. Those concessions can be used for interest rate buy downs. A really quick description of that. Interest rate buy down, let's say, for example, a seller agreed to a seller concession of 3%, and that 3% equates to $30,000. The buyer can, in a higher interest rate market, take that $30,000, place it in their escrow account with their lender, which will allow them to, we call it interest rate buy down. It can be 3-2-1, 2-1, 1-1. But using a 3-2-1 example, it is going to bring their interest rate down 3% in year one, 2% in year two, 1% in year three. 3-2-1 buy down. That
Maybe we can do the class about that too.
Oh, for sure, for sure. Yeah, that's a whole talk. But again, that is going to bring their interest rate down 3%, 2%, and 1%. They're still going to have the market effective rate. So let's say, for example, right now the interest rate are about 6.5%, 7%. So let's just use 7%. Using the same hypothetical, the seller agreed to a 3% concession, which comes out to $30,000. The buyer has decided they want to use that money for a 3-2-1 buy down. And using that $30,000, even though their loan is going to be locked and their rate is 7% on paper, in a 3-2-1 buy down scenario, their payment is going to be as if their rate was 4%, because it's brought down 3% in year one. In year two, their payment is going to be as if their rate was 5%, because it's brought down 2% in year two. In year three, their payment is going to be as if their rate was 6%, because it's brought down 1% in year three. 3-2-1 buy down. The strategy is that, the thought process is that by the time they get to year four, the interest rates in the market have come down to where they can change their locked effective interest rate from 7% to say 4-5%. That's called a 3-2-1 buy down. And that strategy allows a buyer to, again, get into a property. That payment is a little bit more than I can stomach right now, but because that seller's $30,000 has been placed in their escrow account, the lender is taking from that $30,000 every month and putting it towards their payment. So the lender is actually receiving a payment of a 7% interest rate, but part of that money is coming from the concession funds of the seller. So like I said, that's a whole training all by itself. And we're
Yes,
definitely gonna get
please.
that on the schedule. Very
And
good question.
after what happened after the 3 years? It resets to 7%?
Yes, ma'am. It goes back to 7%. Year four goes back to 7% unless they refinance and
Mm-hmm.
lock it at a lower interest rate. This
I
was
see.
very common again when rates were like at 7-8%. And
Mm-hmm.
so let's finish out that hypothetical. Let's say, for example, in year 2.5, rates do drop and they can go from a 7 to a 4.5. They will refinance, take their interest rate to a 4.5%, and the balance of that money, it doesn't go away. It goes towards their to their principal.
Mm-hmm. I see. But what was something that when you're getting a loan, to find out with the what's if the loan qualify for seller concession and what's the max limit? Something that's what you said it before. That's what I was
Right.
asking.
So I'll put a table in. I didn't know. So thank you for that. So now I got to put a table in there for you guys. So there's a table for that. So we'll make sure it won't be today, it may not even be tomorrow. We're gonna drop a table in school where you guys can see that chart. It'll tell you the loan type and what the max seller concession can be for that loan type based upon the loan product.
Mm-hmm.
All right.
Thank you.
No problem. All good questions. We gotta do a whole training on seller concessions, apparently.
Yes.
Oh, you're welcome, Courtney. Good to see you. All right, Kaylin. Hey, Marinette. Ah! All right, guys. You're welcome. All right, guys. Have a great weekend.
Thank you.
Oh, thank you, Steve. Good to meet you. See you guys next Thursday. Bye.
Hey, real
Yes,
quick. I'm so sorry.
no problem.
One real quick question. I was
Go
gonna
ahead.
try to type it, but I didn't have the time, and I know everybody's trying to get off and everything. But real quick, so how will you know what type of loan your client will qualify for?
So you will know once they meet with the lender and the lender tells them, here are your options.
Oh, okay. So
But
the
you're not
lender
gonna
is the
know.
one that really determines.
Correct. Well, the client is
Okay.
going to select it, but they're going to be provided options.
Okay, I got
They're
you.
going to be
Okay,
provided,
all
yeah,
right.
so they're going to be provided options of what they qualify for, what they can use. So a very basic example for uh let's say for example the buyer would qualify for FHA or some other loan product. So the lender would say, here are the loan options. Which one do you like? Obviously, FHA is going to be 3.5%. Here's a conventional that you only put 3% down, right? But this is the rate, and but you know, so the buyer is going to select. All right, good question. Do you refer lenders? I am a lender, Arlette. I am a lender. I'll make sure to put the information in. I am a lender. Yes, ma'am. We are a one-stop shop. Yeah. Yes. One-stop shop. Yes. We had a lot of
All right,
information.
thanks again.
No problem.
All right, have a good
All right,
weekend.
guys. I'll see y'all.